Andy Kim here. Welcome to Intermediate Corporate Finance third week's lecture portion. Today we're going to talk about relative valuation and contingent claim valuation as two alternative valuation framework instead of DCF, right? But our class, our semester will be mostly focused on DCF. You should remember that. Also, if time permits, we will go through the concept of risk-free rate. Risk-free rate, that's i.e. the central banks or the treasury rate, US Treasury rate or Korean Treasury rate. And then before we move on, right, let's take a look at what's going on in the stock market, right? Let's take a look at it. The way I typically do it for American stock market is CNBC.com or go to businessinsider.com or Bloomberg.com because they are prominent financial media these days. And here in CNBC, you see breaking news. Bank of England cuts main interest rate from 0.75% to 0.25%. So 0.5% rate cut. Okay. So this is, right? This is the rate we're going to talk about today in risk-free rate. Can I write something over here? Okay, fine. Okay. And then top news, it says coronavirus live updates. US cases cross 1,000. South Korea reports 242 new cases. So things are reported like this, okay? And then if we scroll down, okay, we can see how the US stock market has been doing, and then especially over last night or yesterday, okay? We can see S&P 500, market movers, or NASDAQ, or Dow Jones, and European stock market, and Asian stock market over here. They are the market movers, the mostly the stocks that showed major movements of up or down that led the trend of the market. Okay, let's get back to S&P 500. You see top and bottom over there. That's top means like among those thousands of stocks in S&P 500, out of 500 different stocks, what were the top performers? Top 1, 2, 3, 4, 5. And what were the bottom performers? 1, 2, 3, 4, 5. Okay. And then S&P 500 is the index of 500 biggest stocks in the United States in terms of the market cap. Okay, in Korean terminology, 시가총액 or 시총. So 500, that's a big number, but how many different stocks do you have in the United States? About 6,000 to 7,000, depending on the time period, right? So in terms of the number of stocks, number of companies, it's like a top 10%, right? You can think about it that way. And most active, okay, stocks are shown over here. What are the securities most frequently traded over last day? And here you see number 1 is SPY, okay? SPY, what is that? Let's click and see. Excuse me, right? Okay, we got poor internet connection, but please bear with me. It shows up. This is SPY is a ticker symbol of SPDR, which is SPDR, S&P Depository Receipt of S&P 500 index. So this is an ETF, exchange traded fund security that follows, that tracks, okay, that tracks the S&P 500 portfolios returns, okay. S&P 500 index, you see it every day, and this ETF is the one that tracks those performance of the S&P 500 index. Average of top 500 companies stock. You can think about it that way. Now you see S&P 5, what's that? The spiders movement like this, and then yesterday it showed about 5.17% up. Okay, so the day before, if you put your money into spider, and then yesterday you must have earned 5.71% if you endured that up and down in the market yesterday. Okay, so this versus that. Okay, that's 5% up. Wow, you may say it. Okay, isn't that a jackpot? You might question, right? But look what happened before. Okay, look what happened before. 5% going up is a big thing, but the day before, about 7% or 8%, it plunged. Okay, so it's not a good time. It's a terribly volatile stock market. Okay, if you scroll it and then try to look at the longer time horizon performance of S&P 500, which is tracked by this SPY Spider ETF, you see there was a very persistent run up in the market, but over the last couple of weeks, since the middle of February, the market index has been plunging like crazy. Okay, like crazy. We call it stock market crash, right? Stock market crash. And then yesterday, 5% going up is just bouncing back a little bit. Okay. First of all, why is there a stock market crash? Because there, as you all know, okay, because of coronavirus concern, all around the world, and especially the supply chain related to China, and not only China these days, okay, global supply chain is getting attacked. And so your future cash flow will be much lower than what you previously expected. Number two, the risk of the cash flow increased. Okay, the coronavirus, where is this going to take us? We don't know. Okay, how dangerous is it? At least what we know for now is that it is infectious, very speedily spreading out, even without any symptom in your body. Okay, and then even after you recover from this disease, there is still a chance that you will be infected one more time or two more times, which is going to be terrible, right? So all in all, this prevents our conventional way of contacting people in business setting, face-to-face meeting, handshaking, all these kind of things, right? Forbidden from now on. Can you imagine that kind of situation? We are experiencing that, right? And then can you imagine this kind of situation persisting over the next, I don't know how many years? We don't know. Okay, is the virus going to go away in the summer? We don't know. What if it sustains? Okay, and the mutant of these viruses just keep developing itself, right? So many different mutants are popping up. And so how can we be ready, and then how can we be clear of this virus concern? So that is hitting that discount rate as well as cash flow together, right? So that's why true value of the companies may be forming at a much lower level than the current stock price level. Okay, how much does it have to go down? Does it have to be like a 40% or 30% down or 10% down? We don't know. At least what we can see is that 10% has been wiped off in the stock market in the US, right? And then bouncing back of yesterday, okay? Bouncing back of yesterday, why was that? Well, Professor Rubini of NYU says that's dead cats bouncing. Okay, it's not a good news, right? It's not a good news, but people just keep buying once there is a stock price crash. Number two, yesterday Donald Trump announced his measure or his new policy to take care of this virus concern, so that they will cut the taxes, income taxes somehow. So for that expectation part, the stock price was bouncing up. But is it going to be effective? Is that policy going to be effective? Do governments in not only in the United States but also all around the world, do they have some flexibility to implement this kind of drastic tax cuts and then sustain their government budgets? That's another question. So that kind of bounce back typically does not last long. Number three, stock market crash does not happen on one day or two. Okay, it happens in zigzag way. What do you mean? If you look at what happened in 2009 in financial crisis, 2008, right? The index level was going up and then went down, okay, so that 40% of market cap disappeared over 3 months horizon, okay, 3 to 4 months. But if you look at day by day return, there was a crash day and then bouncing day, crash day and bouncing day. It was like a 5% crash downwards, right? The next day, 3% up. Wow. Okay. Typically, if it is a peaceful time, right? In index return, 1.5% up or down is just normal situation, or even less. Okay. Why? The index return, the standard deviation of this standard deviation of daily index return is 1.5%. So within that range, up or down, no surprise. Of course, in the news, okay, you have to be careful. In economic news, they will write like exaggerating way. Sometimes, even when there is just 0.3% up, the news will say, "Whoa, there's such the stock price was going up." But those are typically exaggeration for other purposes. We don't know. Okay. The journalists, they have their own agenda. We have to think about that. Somebody pays them for the advertisement, right? So don't get misled. But 1.5% or something is a typical range, okay, day by day. But 5% up or down, that's huge, okay? And that kind of plunging happened in 2008 and 9, and then it was always like a crash and bouncing, 5% down and 2% up. Wow, still a surprise, but that's dead cats bouncing, okay? And then once the stock market index plunged back to a 40% level, okay, the market index started to rally back again. Why was that possible? Because there was a coordinated effort of central governments, coordination among U.S. government, U.S. Treasury, and central banks, Federal Reserve, together with the European Central Bank and Asian central banks, all these kind of financial supervisories, they were working together. They had the flexibility to move and then implement some drastic measures to rescue the stock market. So the fundamental was secured. Okay, and then afterwards we saw a lot of quantitative easing, and all these efforts were done. So that's why over the last 10 years, okay, we've been having this kind of stock market rallies, especially in the United States. Okay, some people already called it. There seem to be a lot of bubbles going on in the U.S. stock market. But other people like Donald Trump has been saying, no, that's not a bubble. That's because of me doing great thing. I hope that was the right thing, but right claim, but maybe not. The bubbles has to be corrected. Not only that bubble portion this time, a new guy or new element or almost like alien attack is happening, the coronavirus, right? We never had this kind of things before. We don't know, okay? So our expectation of future cash flow has to be really adjusted to a new equilibrium. We don't know where that has to be, okay? So that's why we are experiencing a drastically volatile stock market. Some of you may ask, right? Is it a good time to buy the stock? Because didn't you say buy low and sell high? What's my answer? Well, buy low, sell high was the first rule of Jim Rogers, right? What was the second rule? Don't invest in what you don't know. Okay? So if you think about that, we don't know about coronavirus yet, what to do with this, and when this thing will settle down. Okay? We don't know. So don't go there, right? That's my primary message. This is no time to buy a stock. Okay, so last night of Korea, this is what happened in the United States. 5% up, like crazy, right? Yeah, but let's look at what happened in South Korean stock market today. Okay, um, I typically go to finance.naver.com. Okay, Naver is by far the largest portal in Korea, and stock market index. You can see it over here, KOSPI. That's right, over here, and you see minus 2.78%. Typically, U.S. stock market and Korean stock market, they are, how do you say, highly correlated with each other because it's globally connected in financial market. And then a lot of portfolio investors are, investing in simultaneously in Korean stock market as well as U.S. stock market. And then the businesses are interconnected. So that's why we have a lot of, how do you say, co-movement. But today is an exception. Today is an exception. Usually, the KOSPI index went down by 2.78%. What did I say before? 1.5% up and down is no surprise. I told you before, the 1.5% up and down. Let me expand this one. Okay. Right. So 1.5% up and down, that's no surprise. But today, about 3% or 2.8% down, not up. Okay. Why is that the case? Well, we'll have to interpret, and then you'll have to look at the market, how do you say, summaries of today later on. But people are just not buying. Okay. Trump's new measure of tax to support the stock market, well, how much effective would that be for Korean stock market? Okay, and would the Korean government be able to implement that kind of things as well? We don't know. Okay, so we are still scared about this kind of virus situation. This is a macro shock. Okay, so having said that, we are now ready to go to relative valuation. What is this? In DCF valuation, you have to worry about two things, right? Cash flow and risk, right? These two fundamental elements, right, was pretty much it. Relative valuation, what is this about? Well, it's about the ratio, okay, for each dollar of some economic fundamental numbers. For example, net income, right? For each dollar of them, how much are the investors willing to pay in the stock market? Okay, so we come up with this kind of standardized measure of comparison. Okay, here we show you a PE ratio, for example. Okay, you're valuing an initial public offering of a company that manufactures or produces computer software. Okay, underwriter's proposed price is $24 per share. At the same time, the price earnings ratio of other publicly traded companies in the same industry are as follows. It is shown. Okay, what is going on over here? First of all, IPO. What is that, IPO? Initial public offering. What is that? Well, here is company's life cycle. Okay, let me draw a picture for you. Now, let's say you start as an entrepreneur, right? Hello, right? You got some great idea. Ding, 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 ding. You got some great idea, and you started a business, right? A software company, right? I'm using Adobe Premiere to edit this video. So let's say you came up with some cool ideas in this movie editing kind of software, right? That would be competing with Adobe, by the way. So you start your own work in your dormitories or in your private garage in your house or whatever places, right? Together, maybe with your friends or family a little bit. But to do that business, what do you need? First of all, you need some investment, okay? Seed money kind of things. So initial stage in your entrepreneurship, well, you can start with $1,000 or $10,000 worth, which may be coming out of your pocket or out of your parents' pocket, right? Or your friends, maybe investors over there. So you have some ownership over there. Let's say you have 100% ownership. 100% ownership. This is your private company you started, okay? Very small company, by the way. But let's say over time, in a couple of years later, okay, your company turned out to be very successful. More and more people want your software, and more people try to download your software, which means you need a better server, okay, higher capacity servers, and then sometimes you have to do a lot of Q&As to any kind of customers over the phone, but you yourself cannot handle it because you are too busy working with this business already. Okay, so you need to hire somebody, and then you have to expand your hardwares like servers or kind of network, and those kind of things need investment. Okay, so what do? Well, ask your friends and neighbors a little more and expand your network, right? Still, okay, maybe you will grow your company a little bit, attracting or inviting more investors. So your ownership becomes like you share, right? You have 60% or 70% ownership or something, and then the remaining part, um, well, you invite other friends, okay, as a private transaction, okay, privately held. So this company, even though it has grown, it is still privately held companies, right? The friends, I say, right? So you do your business with expanded capacity, and then a couple of years later, fortunately, let's say your product and services has been very, very popular in outside world. Now you have to take care of the customers coming from the United States and in Europe and all around Africa and Asia. They love your product somehow. I hope that happens to you. But for that, you need a much larger servers and then much larger computer capacities, right? and you have to hire a lot more people. You cannot handle with this original investment. So what do? Okay. Um, at that stage, what people typically do is initial public offering. Okay. So go to the investment banker and say, hey, banker, Mr. Banker, okay, can you take my company to the stock market? Okay. So that the general public, okay, public investors all around the world, or if it is in Korean stock market, Korean general public investors will learn about my company and invest their money into my promising business, so that I could expand this business to the capacity that my customers want, right? Things like that. So that's what they do in IPO. Okay, your company size will grow, and your ownership, I don't know how much, but let's say 51%, for example, belongs to you still, but the remaining part, okay, we are going to, how do you say, introduce and sell the ownership to the general public somehow, okay? Um, let's say this 51% is uh, all this ownership over here, not just yours, but your friends and things like that, okay? The remaining part gets floated in the stock market, okay? For that purpose, you need an investment banker because you're not well connected in the financial market. And they are the middleman who does this kind of job. Okay, they know a lot of people with money, high net worth people, high net worth persons, individuals, right? Call up a phone call, right, and then introduce your company, and they will, arrange some of that, and plus they will introduce to the millions of small individual shareholders as well as institutional shareholders. They will spread around all of that. For that part, we call it underwriting process, underwriting. And then the investment bankers get some fees out of it, fee business, okay? Um, so that's general public, right? IPO, initial public offering. This is what is done, okay? So the life cycle of the company will be like what? Well, let's use this pink one. Starting, growing, growing, and after a certain stage, your growth of your company will stabilize, right? But typically in their initial young stage, the companies go public. We say go public, right? Go west, go public. Yeah, that's what's going on over here. All right. So at this stage of IPO, let's say this, okay, in the timeline, okay, what's the challenge? What's the challenge in IPO, right? Let's say in this stage, after this, your company will have your stock price because people will be trading, buying and selling your stock day by day, hopefully day by day. So that transaction price will be observable to the general public, right? But at this point of going public, you don't have the price information precisely, right? You don't have price information precisely. All you have may be the price of your shares per shares, right? At this stage or previous stage, which was like 2 years ago or 3 years ago, and a very small amount of it in very infrequent manner. So even though their historical price might be available, but it's not informative. That's not reflecting your company's stage right now. Okay, 2 years before or 5 years ago, we don't know, right? That's not informative, right? So at this point, if the investors, outside investors, millions of them, want to buy your stock, your company's stock, how much should they pay, right? What's the fair value of your stock? That's some investment bankers have to come up, right? What's the fair value at this stage? is an issue. So price of your stock, let's say your stock, PY, your stock. We don't know. Okay, we just have to trade it, but we have to launch it, but we need to claim certain price and then register it in the market somehow with the help of the investment bankers. So how does the investment bankers, future you, come up with this fair price at the initial stage? That's a big challenge, right? So how do they do it? Well, the idea is, let's look at the industry competitors, right? So as long as they are doing the same business and economic fundamentals is similar to your company, then their price should be your company's price. That's the idea. Simple, right? So your competitor's price, okay, PC, should be equivalent to your company's price. But before we say this is exactly equal, what should we be careful about? Okay, we cannot easily say this has to be exactly the same, but it has to be equivalent somehow. Why do I say equivalent instead of saying exactly the same? Because different companies have different number of shares outstanding, even though their economic fundamentals are the same, right? Even if the company's size is the same, their number of shares outstanding differs widely. For example, the market, there's relation in Finance 101. Market cap is nothing but your price per share times number of shares outstanding. I'll say SHR out, shares outstanding, right? Price times number of shares outstanding. The trouble is, different companies have different number of shares outstanding. And then the market cap is the company's size, right? Size of the companies, even if the company's size is the same, if you have smaller number of shares outstanding, your price per share will be bigger. Vice versa. If your number of shares outstanding is very big, then the price per share will be very small. So you cannot compare the price per share of your competitors with the price per share of your own companies, okay, because of that number of shares outstanding concern. And so in that sense, you have to have some kind of a standardized way of comparison. And then the standardized way, what do you mean? Well, this is market's perception or expectation about you, okay? But the economic fundamental, okay, can be something different. The price can be all around the world, right? Can be deviating from the fundamentals depending on the supply and demand in the market, and then liquidity, something called liquidity in the stock market. So let's bring some economic fundamentals element over here as a denominator. For example, EPS, which is net income divided by number of shares outstanding. Okay? All right. Right, number of shares outstanding. What's going on over here? This net income is a counting number, first of all, and it reflects the economic fundamental, which is close to the cash flow of your company, close to cash flow. I don't say exactly the same. You'll see why throughout this semester. Anyway, but this is a good way of a good starting point. Net income. As long as you took accounting 101, everybody knows net income, right? The benefit of this EPS is that it is divided by number of shares outstanding, which makes it comparable to usable in this framework because your price, okay, is also market cap divided by number of shares outstanding. Make sense? Right. So if you think about it mathematically, in the numerator you have number of shares outstanding, And the denominator, you have number of shares outstanding. So these guys cancel each other out, right? So price per share divided by EPS is nothing but market cap per net income. The idea of this ratio is how much are the investors in the market willing to pay for your stock for each dollar of net income. Okay, for each dollar of net income, how much are the investors in the market willing to pay for your company? Okay, and we define this, we call this PE ratio. In American jargon, PE ratio. In Korean financial market, they call it PER, P-E-R, PE ratio. I don't care whether you call it PE or PER or PER. I assume that they are the same thing. Okay. Anyway, so PER is there. By the way, it sounds strange, PER in Korean terminology, because PER means like scooping something. 퍼, 푸긴 뭘 퍼? Like a, anyway, so that's that. Now, PE ratio is our relative valuation, most typical, popularly used relative valuation metric. So bring the PE ratio of your competitor, okay? So PE, EPS of your competitors, okay? And then you're going to have a lot of PE ratios of your competitor 2, 3, 4, 5, and P of CN, EPS of CN. Can you see this? Right? Right. Like that. Right? So you are going to have a big data or sample of whole lot of PE ratios of your competitors, right? And then you can get some representative PE ratio of your competitors, okay, competitors like that. Typically median or mean without outliers, right? Either median or mean of PE ratios of your competitors. Then you get the representative PE ratio. The idea is whatever the stock investors in the market will be willing to pay for your company's EPS should be this guy, your industry's PE ratio, representative PE ratio. And then based on that PE ratio, multiply the EPS of your company. And then you will be able to come up with your company's fair price in the market. Okay? Remember, this guy, at this point, right? The fair price is not observable. Your company is still yet to be launched in the stock market. But how can we estimate this fair value? Using industry representative PE ratio, and then multiply your company's EPS so that you can come up with your fair value of your price per share. Okay? That's what's going on in this table. So let's see. One by one. I said this is a software company like Adobe, right? Adobe Systems. PE ratio is 23.2, which is, let's see, I'm going to use blue. Adobe PE ratio is 23.2, which means price earnings ratio of Adobe. So that means for each dollar of EPS of Adobe, okay, the investors outside in the stock market, they're willing to pay 23.2 times as a stock price per share, right? How about Autodesk? $20.4. So different companies, but $1 of net income, and then investors perceive Adobe is highly valued, okay, more valuable than Autodesk. They're willing to pay more dollars for each dollar of net income, right? Let's see. Broader Bund. Sounds more like German. Bund. Okay, 32.8 times. So for this company, it is highly valued, higher valued than Adobe Systems. Computer Associates, 18 times. Lotus Development, 24.1 times. Microsoft, 27.4 times. Novell, 30 times. Oracle, 37.8 times. Oh my God. Software publishing 10.6 times. What's going on over here? Very low. System software 15.7 times. So software publishing, you can see that compared to Oracle, right? For each dollar of net income, investors are a lot less willing to pay for software publishing in the stock market, right? Whereas Oracle, people are overly enjoying, overly welcoming the Oracle, right? So based on these industry peers, right, you can take the average of PE ratio, which is 24 times, right? But before you take directly, okay, this 24 times as a representative PE ratio of your industry, you have to stop and think. Some of them, those PE ratios, seem to be outliers, right? Top and bottom of them, okay, just take it out because they may be screwing up our estimation of the average or mean, right? So after taking out those, what's that? This is last two, right? Instead of the higher ones, we drop the bottom ones. Perhaps because this is a tech industry, people tend to be estimating the PE ratio higher. So 37 point something is not such an outlier, but 10 times or 15 times is indeed an outlier. So we take out those bottom two, okay? So after taking out those bottom outliers, the average of this would be 26.7 times, right? So all in all, in software industry, we can see that for each dollar of net income, people in the stock market are willing to pay as a stock price 26.7 times. Okay, so applying the same idea to your company, okay, your company, you don't have price in the market, but you have at least net income, right, figure in your accounting book, okay, because in your private company stage, you have accounting information. So why don't we multiply this 26.7 times your EPS, earnings per share, okay? How much should new shares be priced if the current earnings is $1 per share? Your EPS is $1 to make the computation very simple. Well, just 26.7125 will be the answer. And what will happen if you remove the two firms with the lowest PE ratio in the sample right? The first bullet point, the answer is 24 because this is before removing the outliers, right? So in the first bullet point, your fair value will be $24. And second bullet point, your fair value would be $26.7 per share, okay? Obviously, two bullet points tell you immediately that there's no true value estimate that is exactly the same, okay? People always use different metrics and different ways and come up with a little bit of different numbers. But you can see that still that the fair value estimate is in that range, close to each other a little bit, right? Anyway, now relative valuation, the value of any asset can be estimated by looking at how the market prices similar or comparable assets, right? In PE ratio, comparable asset, comparable fundamental item was net income, okay? For each dollar of net income, how much are the investors willing to pay? Philosophical basis is that the intrinsic value of an asset is impossible to estimate. The value of asset is whatever the market is willing to pay for it. Okay? As long as the investors in the market are willing to pay for $26.7 per dollar of net income, this is what you should command as a stock price. That's the idea. Information required. Well, the existence of large number of comparable assets, right? The more number of comparable companies, competitors, the better it is, because your estimation will have a lot more confidence in it, so that you have more precise value estimate. A standardized measure of value has to be there. In this case, PE ratio. What was that? The standardizer or the denominator was net income or EPS in this case, right? Some variables that is related to the fundamentals, something related to the cash flow, right? Something that is related to your economic activity, right? If the assets are not perfectly comparable, variables to control for the differences. So sometimes the common denominator may be absent. Okay, in that case, you have to come up with some other alternative measures, right, or control for those specific situations. And this kind of things you're going to learn a little more as we go down to down the road in the semester. And then the relative valuation, basic premise is that is about market inefficiency, right? Whether the market is efficient or not. Okay. Here, pricing errors made across similar or comparable assets are easier to spot, easier to exploit, and are much more quickly corrected. So here in relative valuation, we are assuming that the market is efficient on average at any given point of time, right? In time series wise, an average market level is efficiently pricing. That's why for this point, we look at the whole lot of different competitors and then estimate the average of it, okay, or representative figure of it, because we believe this is efficient level of PE ratio at this moment, okay, and then apply it to your own company's net income, right? But we don't assume each and every stock to be priced efficiently, okay? So any given point of time, some companies' PE ratios may be too high, some companies' PE ratios may be too low. Can you see this one picture? Let me expand this, okay? Yeah, hello, right? So let me scroll it down a little bit. Yes. So any given point of time, right? Different companies have different PE ratios, right? Different PE ratios, up and down. Some you saw that, right? Oracle very high, 37 times, and then the others, right? Adobe 20, what was that? 20 something, right? In middle 20, right? And then some of them had 10 or something like that. Some of them may be over or underpriced compared to the fair value or the average level. We assume that this average is efficient. Each component may be inefficiently priced. Okay? So that's why we are taking that representative number over here and then use it as a fair price at that moment. Another thing is, getting away from this IPO setting, another thing using this relative valuation is that, well, okay, at every moment is everything, on average, market is efficient, but component stocks may be inefficiently priced. For example, Oracle in this previous example, okay, Oracle 37 times seems like overvalued, okay? Over time, as we move down the road in timeline, what will happen to this overpriced stock? We'll get to the efficient level later on, okay? So the investment strategy for overpriced stocks in PE ratios, what's the best strategy? Short sell it. On the other hand, if your company's PE ratio is too low, what's the idea? Over time, it gets corrected to the fair value level, PE ratio. So what's the investment strategy over here? Buy it. Buy low, sell high. Okay? That's the idea going on, right? Time series wise, average level is efficient. That's interesting distinction between relative valuation versus DCF valuation. In relative valuation, there is no such thing as bubble or crash. Okay? Even in the crash situation, some people, we assume the average is efficiently priced. Some guys are relatively more crashing, some guys are less crashing. Even in the bubble situation, on average, we don't call it bubble or anything, we don't care. All we care about is which one is relatively more overvalued and relatively less overvalued, okay? And then, depending on that relative stance, we take a position, like buy and sell, and then make money out of it, right? So that's relative valuation. How about in DCF? In DCF, well, we assume the market is inefficient in the short run. But in the long run, it gets corrected so that long run market is efficient. But in the short run, I don't know the definition of short run. It may be 1 year or 3 years, right? It may be inefficiently priced. So it's Warren Buffett kind of idea, Carl Icahn kind of idea. Find out the ones that is undervalued, okay, undervalued in absolute sense, not in relative sense. And then buy that stock, hold on it, and then wait until it gets correctly priced. That's the idea of fundamental or DCF valuation. Now, okay, advantages of relative valuation is the next thing to discuss a little bit. Relative valuation is much more likely to reflect market perceptions and moods than discounted cash flow valuation. This can be an advantage when it is important that the price reflects these perceptions, as is the case when the objective is to sell a security at that price today, as in the case of IPO, and investing on momentum-based strategies. Momentum, what do you mean? Well, that's some quantitative trading strategy, right? If you look back in the past, stocks that has been performing well will be keep on performing good. And the stocks that has been going down to the toilets, they will keep on doing diarrheas over the next, couple of months, right? That's the idea of momentum. Some kind of inertia going on, right? So why don't you ride on that kind of momentum and then trade based on it? That's the idea of momentum. So for that part, you need some kind of relative comparison. That's why we need it. With relative valuation, there will always be a significant portion of securities that are undervalued and overvalued. Of course, because we take the average of it, and then if we take median, by the way, which is equivalent, right, in the sense that it is representative of PE ratio, that kind of metric, take the median. 50% has to be bigger than this, 50% has to be lower than this, smaller than this, right? So that there will be fair enough of a proportion of securities that are undervalued and overvalued so that you will be able to trade, okay, based on this judgment. Since portfolio managers are judged based upon how they perform on a relative basis to market index or other money managers, relative valuation is more tailored to their needs. So if you think back about the buy side, the fund managers, National Pension Fund or Ultimate Gap kind of guys, right? Their performance is evaluated on a relative competition among other similar equity investors or portfolio managers, right? So for them, this kind of relative valuation framework will be more helpful because they have to hold on to equity stocks anyway, okay? And they, for that purpose, they will be challenged all the time. Why do you hold this stock? This seems to be a loser stock. But they are going to be able to defend themselves. Oh, relatively, they're undervalued right now, so it is worth investing right now. Soon it will be corrected so that I will earn money, okay, make money. Now, relative valuation generally requires less information than discounted cash flow valuation. It takes shorter amount of time to explain, okay? Instead of saying that, you know what, this iPhone companies, right? I say that I use a three-stage growth model of like 20 years down the road using this kind of cash flows and assuming this and that, and then the discount rate to be somewhat, blah, blah, blah. If you try to sell your pitch, right, buy sell recommendation with this kind of DCF approach, the people on the other side will kick you out because it's like a too time consuming. Instead, if you go there and then, or call up the potential investors and say, Apple is a nice buy today. Samsung and versus Apple, their PE ratio. Samsung is like 25 times, but Apple is like a 20 times this day. You know what? Apple will converge to Samsung's PE ratio quite soon. Go ahead and buy it. Oh, okay, PE ratio 25 versus 20. Takes just 15 seconds to consider that, and easy sell, right? So that's why this is much more popular in analyst world in reporting and this kind of things, sales pitch kind of things. But in this class, we are not going to focus on relative valuation because this is corporate finance class. So we need a lot more of an understanding of fundamental elements, cash flow elements. So that's why, okay? Disadvantage of relative valuation, a portfolio that is composed of stocks which are undervalued on a relative basis may still be overvalued even if the analyst judgments are right. It is just less overvalued than other securities in the market. So in the bubble period, in the tech bubble, right? Or these days, AI bubble, I call it. Any companies that claim to have something to do with AI, machine learning, or anything, their stock price would be, valued very high in the market. So if you think about a portfolio composed of tech stocks, they may be overvalued sometimes. Okay, the portfolios that is focused on managers that is exclusively focused on this tech stocks, they may be sitting on these bubble stocks all the time, not realizing they are really in the what they are doing. Okay, they may be justifying themselves that, oh yeah, relatively this stocks that I hold is relatively undervalued, but what for? It is everything is overvalued, so when the crash comes, you're going to suffer altogether. Relative valuation is built on the assumption that markets are correct in the aggregate, but makes mistakes on individual securities. To the degree that markets can be over or undervalued in the aggregate, relative valuation will fail. Okay. Relative valuation may require less information in the way in which most analysts and portfolio managers use it. However, this is because implicit assumptions are made about the other variables, right, that would have been required in a discounted cash flow valuation. So you have to be watchful about this usage of relative valuation. To the extent that these implicit assumptions are wrong, the relative valuation will also be wrong. So be careful. So relative valuation seems like a high fly. You can easy to sell, okay, easy to do a sales pitch with this one, but you have to be careful about using it, okay? And is it completely divorcing away from the economic fundamentals as opposed to DCF valuation? The answer is no. Even if you're using relative valuation, you need even more solid understanding of DCF, because you will learn later on that those relative valuation metrics you can analyze mathematically and find out that it is those fundamental or DCF components are still driving your relative valuation multiples. For example, PE ratio. Is it related to cash flow by any chance? The answer is yes, because you will see that the PE ratio of mathematical analysis tells you that significant component of it is the growth rate. Okay, so if the idea is that if the investors expect a high growth rate of your company going into the future, okay, your net income growth will be high in the future, then your price per share will be high, so that the PE ratio will be formed highly already in the first place. So you'll have to be able to decipher these kind of economic drivers behind this relative valuation metrics. High PE ratio of, what was it, Oracle before, okay? Previously, I just simply said, it seems like it's overvalued because we are comparing with the average of the industry, but it may be that the Oracle had a much more growth potential compared to Adobe or others, right? If that is the case, then you have to be careful. It's not really correct to say this is overvalued, okay? This high PE ratio may be justified by high growth rate, okay? So growth rate and PE ratio, growth rate of the cash flow, okay? The fundamental element is still driving the relative valuation multiple, okay? Multiples are very easy to misuse and manipulate. So you will see a lot of different analysts coming up with a whole lot of crazy multiples in the future. Because, for example, machine learning industry or AI kind of industries, maybe the company is in this startup stage so much so that they don't have net income yet. Instead, they have net loss, minus number. PE ratio, you cannot use it. What would you do with this? In dot-com bubble period, they used to come up with this idea of price per click or price per eyeballs. What do you mean? Well, because this Amazon.com kind of .com companies used to have negative net income, okay? So they could not use PE ratio. Instead, they had this kind of figures, data about how many clicks were there in their website. So the idea is, well, the more people click on this website, the more sales it will generate and the more cash flow will come in the future and more growth will come in the future. So the price per share should be correlated with this click numbers. So let's use that number like a price per clicks and how many people, how eyeballs are watching it, right? That's similar idea. And that kind of ideas may be used for AI-based industries. But you have to be careful whether these kind of new multiples make sense or not. Some of them make sense, some of them don't. So your job as a reader of those kind of reports, you'll have to be careful. This is new measure, new metric they come up with, but seems like it's too much of a stretch. Then you can just dump it, right? Get ready. Now, multiples of Google versus Apple is shown over here, right? All right. So valuation measures are listed in the first column. Google and Apple, you see GUUG, right? The Google stock symbol in the US stock market. And Apple, Apple, right? AAPL, right? Quite intuitive spellings. Now, market cap of these companies, I'm not calling that relative valuation measure. And enterprise value, we see it over there. What is enterprise value? We're going to touch on this issue later on, so wait for that. It's firm value minus cash, by the way. Trailing PE ratio. Now we see PE ratio, forward PE ratio, and then you see essentially PE ratio is shown in different ways. Okay, How do you distinguish trailing PE versus forward PE? Well, trailing PE, forward PE, commonly they have price per share today as the numerator. But what goes into that denominator differs. Trailing PE uses trailing EPS, historical PES, right? Historical earnings per share, okay? Last year's net income. Forward PE is about analyst expectation about future net income or earnings per share, okay? You're sitting in, for example, in the middle of the year. Shall I draw a timeline over here again? Yeah, right. Trailing PE versus forward PE. Let's say 2019 December 31st, 2020 December 31st, and you are sitting over here, which is hello, yes, here. This is March 10th, right? So trailing will be about the past, trailing 12 months, right? Over the 12 months, what was your net income and EPS? That's your denominator over there. Forward is this period over here. Forward at the end of this fiscal year, which is yet to come. Okay, what is the expected EPS? Okay, we don't know. The analysts, the experts throw out their EPS figure. Okay, so based on those averages, okay, of EPS, take the PE ratio. That's the idea. Okay, PEG ratio. What is that? PE ratio divided by expected growth rate of EPS in the future. PEG ratio. PE ratio divided by growth rate, which came from Peter Lynch, right? Peter Lynch, can we? Yeah, one famous guy, One Up on Wall Street is his bestseller book in the whole world. Peter Lynch, he sold this PEG ratio idea and it made his name in the Wall Street. He worked for what's that? Fidelity, Magellan Fund, is that right? Okay. Anyway, so that's PEG ratio, and then the price to sales ratio and price to book ratios are there. Why don't we use PE ratio? Isn't it just simple and easy? Yeah, you're right, but as I said before, sometimes the companies have negative net income, which is loss. You cannot use PE ratios. Minus PE ratio doesn't mean anything. So in that case, you'll have to go up the ladder of this income statement. For example, instead of net income, maybe you may be using like operating earnings, because operating earnings are less likely to be negative, right? But in some cases, you have negative operating earnings. So in that case, what do? Well, go up even further so that work with this sales figure, right? Because no negative sales figure can be possible, right? The companies have positive sales all the time, right? So that's why you use this number and then compare to the sales dollars, how much are the investors willing to pay, okay? The caveat is that you have to be careful when you compare those companies in the same industries with PE ratio. Compare with PE ratio, be consistent internally. Don't throw in PS ratio and compare them, right? No way, okay? The metric has to be common across these comparable firms. Price to sales ratio, one of them. Price to book ratio, what is that? Well, for each dollar of book value of equity, how much are the investors in the market willing to pay for your equity stocks, right? And then enterprise value per sales, EV to sales or EV to revenue ratio is shown over there. And then EV to EBITDA ratio is also there. Revenues is equal to sales, right? So for each dollar of sales, how much are the investors in the stock market and bond market are willing to pay? Those weighted average investors, right? Excluding cash. That's the idea of enterprise value. And then EBITDA, what is that? Okay, earnings before interest, tax, and depreciation and amortization. So we're going to learn about this EBITDA later on. Essentially, the EBITDA is about proxy for operating cash flow. So based on your day-to-day business, right? Based on your day-to-day business, for each dollar of earnings in your day-to-day business, the cash flow, how much are the investors in the market are willing to pay? Okay, so based on these metrics, you can compare this Apple versus Google. Okay, in this table. Now, when relative valuation works best, this approach is easiest to use when there are large number of assets comparable to the ones being valued. For example, as I said before, like if there are, I mean, when you are valuing apartment units, right? 108 square meters apartment in Gangnam area, right? You have thousands of similar units all around, right? Maybe hundreds. So that's basically your apartment unit's value. That's it. Okay, we don't go for DCF valuation. Oh, this bedroom will give you a certain cash flow, and then toilet will give you a certain amount of cash flow. Oh, come on, good luck with that, right? These assets are priced in a market, right? So you need an open market where you can see fair market, the price over there. There exist some common variables that can be used to standardize the price. For example, in this case over there, net income, accounting earnings, right? Some common variable has to be there. This approach tends to work best for investors who have relatively short time horizon because the mispricing in each component stocks, right, in our comparable sets, those mispricing will be corrected in short amount of time, like 2 months, 3 months, right? Not 2 years, 3 years down the road, okay? Now, this approach works best for investors that are judged based upon relative benchmark, right? Other portfolio managers follow the same investment style, etc. So the portfolio managers in a certain equity class, those kind of guys will be favoring this kind of relative valuation approaches. And pretty much most of the fund managers, right? This approach works best for the investors that can take actions that can take advantage of the relative mispricing. For instance, a hedge fund that can buy the undervalued and short sell the overvalued assets, right? I said before, relatively overvalued and undervalued ones, okay? In the same industry, well, buy low, sell high. This time, short sell high. Okay, we call it pairs trading. Okay, pairs trading, which means like we make a pair of overvalued and undervalued stocks. Identify those overvalued and undervalued stocks in a relative sense, and then take long short position, which means first of all, short sell those overvalued stock, and then by short selling, we mean that you borrow that stock from another investor, let's say Samsung Life Insurance, and then borrow it and sell it. We call it short sell. Okay, short sell. And then by that, we get the cash. With that cash, what do? Buy this undervalued stock, right? So in theory, you just don't need to invest anything out of your pocket, but take a long short position with this short position generating cash immediately and taking long position out of it. And after 2 months or 3 months down the road, the relative PE ratio, right? This relative valuation metric will converge to the average, right? As it converges, you will make money in your long investment, and you will make money in your short investment. So that's the idea. Now, what approach would work for you? Okay. At this stage, if I ask this kind of questions, what would be your answer? As an investor, given your investment philosophy, time horizon, and beliefs about markets, which approaches valuation would you choose? DCF or relative valuation? And beginning or student level, they favor much more of a DCF valuation because this is much more familiar and it has much more economic appealing, right? Economic fundamentals, true value, and then the intrinsic value is discovered with this DCF valuation. But as you learn and then get experience in the industry, and you will see that a lot more people favor relative valuation. Okay, the portfolio managers or those guys in the industry, they work with relative valuation much more often, right? But that does not mean that DCF is a bullshitting, because as I said before, in the heart of relative valuation, there is always DCF component that is driving the relative valuation. So at the student level, you have to master the DCF first. And then for mastering those DCF, you need to understand the corporate financial mechanism, okay? Like capital budgeting, capital structure, and then dividend payout. All this kind of decision making has to be incorporated in the DCF valuation later on, okay?